otro sitio. Nos especializamos en garantizarles los boletos de avión más baratos, con descuentos en habitaciones de hotel, alquiler de carros y grandes ofertas en paquetes para cualquier lugar del mundo. No importa su destino, podemos ayudarle.
Gracias, Vuelos y Más.
¿Qué espera? Llame ya.
Broadcasting live from Houston, from the space city to the world. You are watching Now Media Television.
Thanks for tuning into the show, everybody. I'm your host, Andrew Glisson. If you haven't met me before, I'm a real estate investor. I started my real estate investing journey in 2007 and accumulated properties all the way up to now until I really quit my W-2 a couple of years ago. I've learned a lot of lessons along the way. I've bought tons of properties. I've renovated them. Most of the time, I'm renting properties out long term. I've got a few short-term rentals. I do a few flips, learn tons of lessons. I'm going to introduce to you guys guests on this show that are going to help you make good decisions in real estate. Whether you're buying a home to live in or whether you're buying investment properties, the people that we are going to interview on this show are going to drop incredible nuggets to you along the way that you can use in your journey. I want to inspire and help inspire you guys by introducing entrepreneurs who are doing what some of you guys want to do or are doing. You can learn things from these folks to implement in your business. So everything in real estate, by the way, is expensive. From buying to working on things to selling, everything has gotten seriously expensive in this business. So education, I fundamentally believe, is really key. The first guest today is a cost segregation expert. If you invest in real estate and have never heard of cost segregation, the conversation that we're about to have with my first guest is fully going to change your paradigm in the business. So stay tuned. We'll be right back.
Taking a trip in the next 12 months? Airlines are under tremendous pressure and they're practically giving away their unsold seats. Like every crisis, this one will end too. But right now is the best time to take advantage of giveaway ticket prices on their unsold seats. We're not allowed to publish these low fares online. The only way to get these rock bottom giveaway prices is to call. So phone low cost airlines now for airline ticket prices you may never see again.
All right, everybody, my first guest on the show today, I'm super excited to introduce to you Yona, a super powerhouse with property owner tax savings, a business director at Madison Specs, a national cost segregation leader. He's assisted clients in saving hundreds of millions of dollars on taxes through cost segregation, has a background in teaching, passion for real estate and helping others, a real estate investor himself, and a host of a top podcast, Weiss Advice. So, Yona Weiss, welcome to the show.
Grateful to be here. Thanks so much for having me.
Man, I have followed you on Twitter for a very long time, and you're on Twitter giving out free advice all the time, in your podcast also. A lot of, when I teed the show up in my intro, I mentioned the fact that a lot of real estate investors have no idea what cost segregation is, and it is one of the most powerful tools in real estate. So, for somebody who purchased, one single-family home last year or an apartment building that has never heard of cost segregation, I'm not going to tell them what it's about. I'm going to let you kind of tee that up. Give us, from a 1.0 level, instruction class, basically, what is the introduction to cost segregation, the idea in general?
Basically, the first thing you need to know is that it's a real estate tax savings strategy. Okay, so simply put, it's a way for you to have more cash flow by paying less income tax. So that's the kind of background to what it is. How it actually works, it's an advanced form of depreciation. And we talk about real estate investing and the great appreciation and equity and so many different things, but the tax benefits that come alongside with it, the main one is something called depreciation. Now, it's a borrowed term, which means depreciation does not mean that your property is going down in value. It means the IRS has given you a tax deduction called depreciation based on the principle that things go down. So anytime you buy a property, besides for your primary residence, whether it's mentioned single family, multifamily, commercial, storage, office, industrial, doesn't matter what kind of property it is, a business or investment property, you're able to literally deduct the entire value of that purchase price over a long period of time. That's called depreciation, and it's typically spread over a 27.5 or 39-year period. The process of cost segregation is breaking down the property into different components, which certain of those components depreciate faster. And so you're able to take those deductions at a much faster rate. So like I said, it's an advanced form of depreciation, and it's a cash flow mechanism pulling from this pool of potential deductions that you may never see and using them in the early years of ownership to pay less taxes.
So walk us through the mechanics of it then. So somebody buys a real estate investment for $300,000, and how does the cost segregation aspect of that depreciation work on a property like that?
So the first thing we do, we always like to run a free upfront analysis for any property just to show what the potential tax savings would be. So typically speaking, with regular depreciation, you're going to take a small portion off from land from the purchase price and then divide that by 27.5. And that's your typical deduction every single year. With cost seg, we're coming in with an engineer and breaking down the property from an construction engineering perspective, showing that the different components of the property actually depreciate on different levels. So for example, you'll have things that are on a 5-year depreciation schedule, like furniture, fixtures, appliances, even things that are attached to the property but are not structural, integral to the structure, like carpeting or flooring, cabinets, countertops, shelving, window treatments, you name it. All that stuff depreciates on a 5-year schedule. So we're coming in, identifying what all those components are, and then giving a value to those components and breaking that out from the purchase price and allowing you to take the deductions of those items over a 5-year period. And then so you're segregating out, there's 5 and 15-year kind of buckets that you're pulling out of the house. What would be an average, percentage that you could allocate theoretically to those buckets off of the, main structure? Yeah, well, every property is different, but it's typically, somewhere in the range of about 20 to 30% in general. And it does, like I said, it does depend on the type of property, the size of the property, the amount of land improvements that are outside, including landscaping, pavement, et cetera, that all that depreciates on a 15-year schedule. So on a single-family home, if it's a long-term rental, it's closer to the 20% range. If it's a short-term rental where you own all the furnishings and amenities, it's going to be closer to the 30% range. Multifamily properties on average about 25%, and et cetera. There are other certain types of properties that may have much higher skewed reallocation of that percentage, like mobile home parks or RV parks, where it's like literally 70 or 80% of the property is going into the land improvements because there's not much structure or structural things on the property. But again, going back to what most people are dealing with, single families, multifamilies, 20 to 30% is pretty average. Yeah, and so the process to kind of go through this a cost segregation study, what does that look like for somebody to do this at their property? It's very simple. It really does not take a lot. The first thing, like I said, we always run a free estimate so you can know ahead of time what that potential benefits are. Then when you engage with us, we send an engineer to the property, either physically or now with the help of technology. We do it via a video call or a Zoom call or something like FaceTime, where they're able to walk and take pictures, videos, and capture measurements from the property. Then we create a report. We'll use some documentation from you, like a closing statement, an appraisal, a site survey that will show certain, measurements and distances of the property, and then create a report. It's about a 90, 100-page report. In there has one page, which is your new depreciation schedule, and that, et cetera, essentially you just hand off to your accountant, and they apply that. That's your deduction year after year. So it's a very simple process. There's really not a lot involved in it, especially from the side of the investor. Where it does get a little complicated is when you're dealing with major renovations or projects like that, where there may be multiple levels to the study and taking into consideration all of those upgrades or capital improvements.
So like for me, for instance, real estate investor, most of the properties that I buy are pretty garbage. They're in real bad shape. And we spend a lot of times the entire cost of what I purchased it for, I'm spending the same amount of money on a renovation. How would a cost segregation study, how would you do that in that circumstance?
So it depends. If for whatever reason you were to rent the property out in its state of disarray before you start the renovations, it's usually not the case. But if that were the case, for any stage, then you can actually do the cost seg in 2 stages and capture the purchase price and then break out all the components from that and get the accelerated depreciation. And then once the renovations are complete, we're going to do another cost segregation on just the components, the money that was spent on the renovations. Now, and in your case probably, and I assume most people's cases, you're buying the property in a state of disarray, renovating it, and then renting it out, right? There's no interim stage where you're going to be renting it or placing it in service beforehand. In that case, you actually miss out the benefits of the depreciation on the accelerated components, et cetera, of the acquisition, and we're just going to be focusing on the renovation component. So if you're spending an equal amount, that means the majority of that money spent, in most cases, is going to be going towards the accelerated depreciation to the 5-year, 15-year. And that's the thing, when we're dealing with renovations, it's a much higher percentage. Typically 50 to 80% of those costs are going to be in the non-structural items, right? I'm sure there are things you're doing, maybe putting up drywall, maybe putting in new windows or doors, things like that. But the majority of that, flooring and cabinets, et cetera, all that stuff is 5-year property.
So what is the cost of a cost seg study? Do you do it by square foot or project? How does that work?
It's a pretty flat fee. So, we're the biggest national company. We do about 6,000-7,000 of these a year. And so it's not, based on contingent to the tax savings. We have a flat kind of rate based on the size and the type of property. So starting at about $3,000 for single family homes. And it really makes sense. People ask me, like, what size property does this make sense for? And if you look at the numbers, the numbers really speak for themselves. Any property purchased for over $200,000, if you're spending $3,000 to get it done, and then the after-tax benefit is going to be, at least 10x of what you're spending, $30,000, $40,000, $50,000. It's well worth it, right? But when you're getting on much smaller properties, under sub $100,000, it usually just doesn't make sense because the ROI or the benefit is not going to be great. However, I mentioned $3,000. That's our current pricing in the state. At this time, I don't want to get caught up in this. If someone viewing this a few years later and coming back and saying, "Hey, how come your price was $3,000 back in 2023? It's not the same in 2025." Who knows what inflation will tell? But it is more expensive for for bigger properties. Multifamily commercial properties can get up to about $6,000-$7,000.
Yeah, and so I've got 2 minutes left, but I wanted you to cover the bonus depreciation side of this real quick. So in 120 seconds, tell us about the bonus side of this, which is really a big advantage for where we're at right now, right?
Absolutely, it's a huge aspect. So back in 2017, there was a tax reform which created this law called bonus depreciation, 100% bonus depreciation, which said once you did a cost segregation study and allocated those costs to 5-year and 15-year schedules, you now had the opportunity to take all of those accelerated deductions in the first year of ownership. That was called 100% bonus depreciation. So instead of spreading those deductions out over a 5-year period, 100% in the first year, that's a huge deduction. Just think about the numbers. If you take $1 million property and instead of taking a $30,000 deduction every single year for straight line depreciation, we're taking, $200,000. We remember 20 to 30%. Let's say $200,000 of that we're going to take upfront as a lump sum in the first year. That's huge. So this year it's gone down to 80%, which means if you bought a property between 2018 and 2022, you're able to take that 100% bonus. If you bought a property in 2023, it's gone down to 80% bonus depreciation. So it's still going to be beneficial, but it is going to be phasing down. So the bonus depreciation is going to be lowering year after year until it's completely phased out.
Yonah, I've got 1,000 more questions I want to ask you, so that just means you've got to come back on the show. These 12-minute segments are just not long enough sometimes, but I want everybody that's watching the show, go follow Yonah on social media. He's all over Twitter. His podcast is great. I've listened to almost every episode that's out there to get free advice. Yonah, you've been great. Thanks for coming on the show. And we're going to head to a break, everybody. We'll be back in a couple of minutes. These are the top 3 questions I get from people about investing in real estate. How much money do I need to get to the next level? How do I find good properties to invest in? Can I even make money in this business when interest rates are so high? I answer these questions and many more in my online course, SFR University, where I show you the strategy that I used to build a multi-million-dollar real estate business in 4 years from scratch. Whether you're just starting out or someone who's looking to scale, this course will have something for you. Join us at sfruniversity.com. See you in the course.
Hey, Lily says AT&T's giving everyone their best deals.
Minus the air quotes.
Best deals.
No need to wink. Others say they give everyone a deal, but not everyone gets the best deal.
Told you, the best deals are for everyone here, with a choice of plans.
You were right.
Is she always right?
Always.
At AT&T, we give everyone our best deals on every smartphone.
Taking a trip in the next 12 months? Airlines are under tremendous pressure and they're practically giving away their unsold seats. Like every crisis, this one will end too. But right now is the best time to take advantage of giveaway ticket prices on their unsold seats. We're not allowed to publish these low fares online. The only way to get these rock bottom giveaway prices is to call. So phone low-cost airlines now for airline ticket prices you may never see again.
Hi, my name is Michelle Merhar. You may remember me from the morning news. I'd like to tell you how getting data and documents into action fast gives you a competitive edge. Digital-first thinking to manage document workflows efficiently are giving all organizations a competitive edge. In fact, digital document automation is an essential process, helping us to become more profitable and to compete. By making any process paperless with secure automation, decisions can be made efficiently, virtually from anywhere. You'll be able to find and share documents securely in seconds. Your staff will be empowered by making optimal use of every office hour. And by the way, the size of your organization doesn't matter. Precision Products has been helping organizations for more than 30 years with paper to digital processes, including scanning systems for any document to premises and cloud document management systems. We make it easy and scalable for your business process needs from the office or other locations, even mobile devices. Contact us to see how we can help your organization succeed. Contact Will Waterall direct at 713-446-5939 and visit us on the web at precisionproductsinc.com.
Welcome back, everybody. Santi, welcome back to the show. For those of you guys who have not met Santi before, Santi works for Community Mortgage, a regional mortgage broker in the South, based out of Memphis. And glad to have you back on the show, Santi.
Hey, thank you for the invitation. Glad to be here.
Sure thing, man. Listen, interest rates, since the last time we talked, it is just going through the roof continually. There was another record high set, over 8% for the 30-year mortgage. I mean, why do we keep on seeing interest rates continually going up? Is there ever a stop to this?
We don't know, right? I mean, everyone is talking about that the rates are going to keep going up. A lot of people say that by this time the rates are going to be down. We don't really know, right? Feds keep raising the rates, and this is going to keep going. Everyone predicts that this is going to stop by the time of the elections, but again, we don't have a crystal ball. We don't know what is going to happen tomorrow. What we have to do is adapt and keep going, you know.
For somebody who's trying to refinance like their mortgage, their personal home, if they have to, right? Sometimes it's unavoidable. They're entering a period where they had a 10-year loan or something like that, construction loan, that's ending. They got to refinance. What are you advising people to do with moving from a 3-4% interest rate up to 8%? I mean, is there any way to mitigate that? Can you buy that rate down at all? What does that cost? What advice are you giving folks?
Yeah, you usually can buy points or reduce the interest rate Usually it's the 1% of the loan amount, and that's going to give you between 1/8 to half of a point better rate. However, there is a max, there is a limit that you can pay in order to reduce your interest rate. Like if the market is 8%, there's no way that you can go all the way to 3%. It's going to be a really hard shot, but probably you are going to be able to get a 7 or 7.5, depending on the points and different options. If you are buying a house, there is the options of buy downs, which reduce your interest rate for the first few years, first, second, and third year. But that's something that has to be negotiated with the seller. There are different options. What is happening is most of the people that have to refi, based on your example, when they come, they realize that their payment is almost double sometimes. So sometimes their debt to income is not enough to cover the payments. So what we are going to do is we will have to find a co-borrower. In the past, you were able to afford the $300,000 house by yourself. Now you need two incomes in order to afford the same exact house. So that's one of the things. The other thing is reducing debt. We have to eliminate that car payment, those credit cards, those installments that are using the space that you could use to put a mortgage. So those are the options, but yes, it's a case-by-case situation for sure.
So talk to me through like debt to income ratio personally. A lot of people probably didn't have to think about that year, 2 years, 3 years ago, but now that's become a very big topic when you're trying to refinance or buy a house. What is a debt to income ratio requirement on a personal mortgage?
Yeah, it depends a lot on the loans. We have some loans that start in 43 all the way to 55 DTI. And what's DTI for a lot of people is the debt to ratio income. Means that if I make $1,000 to make it easy, the bank is going to let you use 45, 50%, 55% of this income in order to buy a house. But if in this 50% or 45 or 55%, I already have a car payment or credit cards or furniture, that's going to be used in the space that I can use to buy my house. So whenever we want to buy a house, we have to make sure that we start paying off some debt, reduce our debt to income, so we can add a new debt that is going to be the house. Depending on the loan, depending also on the credit, if you have a low credit, sometimes 43 is the max that we can get, but it depends on the low FHA. Lets you go high. I have done 49s, 50. There are other non-conforming loans that you can get to 55 that allows you to go farther, but also the interest rate might be higher on those type of products.
Let's go back. Every time I talk to you, there's just so many topics I want to ask you questions about because you pack a lot of knowledge into like one little segment here. But going back to buying down the rate for a minute, and then I want to get back into debt to income ratio. If you buy the rate down, and you said it's 1% of the loan amount. So let's say you've got a $200,000 loan, you can buy 1% of the rate down for $2,000, but you can only do that for a certain amount of years. So it's not for the life of the loan.
There are two options, okay? The buy down program, the one that is when you are buying a house, is something that has to come from the seller. Let's say that the seller is going to pay around 3% in concessions. That money you can use to either reduce your closing costs or to buy down the rate. In this option, in this buy down option, your interest rate is going to go down. For example, the 2-by-1 is going to reduce your interest rate 2 points. So if you have right now 8, it's going to go down to 6% the first year. The second year is going to go to 7%, but the third year is going to go back to normal to 8%. So it's going to be a temporary part. That's the buy down when you buy a house. Now, the other option is buying discount points or origination. Most of the people call it points. What is that? Is paying 1% of the loan amount to reduce my interest rate permanently. For example, in your example of $300,000, you pay 1% of the loan amount, and that's going to reduce your interest rate either an 8, a quarter, a half of a point, depending on the market, on your credit. I have seen it like, for example, I have seen people paying 2 points, that is 2% of the loan amount, and have been able to reduce entire from 8% to 7%. For example, I have seen something like that, but it also depends on the market, many factors, the type of loan, your credit, LTV, and different things.
So can you stack that seller credit up with buying discount points, and you can take the full seller credit, apply it to the loan, and buy some discount points and really kind of reduce that payment first, second year, and then, permanently?
You can. It depends on the program. It is hard because you're asking 3% to the seller, and most of the sellers are not willing to give you that much money. So, I mean, in a perfect scenario, you have all the money and you're getting the 3% from the seller. Yeah, you can probably do it, but it depends on the program too. And I mean, different programs have different requirements.
Gotcha. Pivot. Let's go back to debt to income ratio for a second. So, 40 to 55%, and everything goes into that, from car payment to credit card payment, minimum payment due, house payment. What else factors into that ratio?
Yeah, things like child support, or either if you have a if you didn't pay your taxes and you have a payment plan with the IRS, that payment plan is also going to affect your debt to ratio, because you need to, the more debt that you have, the less amount of money that you can qualify. So ideal, if you're planning to buy a house, you want to prepare yourself with at least 6 months before the time that you are going to start looking for houses, and start paying all the debt, because all these little cars, all of these car payments and child support and student loans, and all of these little pieces are going to become, they're going to be using the space that you can use to buy your house. Now, based on the interest rate, going back to the topic that we were talking is, so are we talking about like not buying a house because the interest rates are high? Well, we don't know, right? Because what if the interest rate keeps going up? So then you lose your chance to buy in a discount price, or the houses. You know that when the interest rates go down, the houses are going to be more desirable, and there are going to be more competition, and you're going to have multiple offers. So it is hard to decide if it's a good time or not. The way that I see it is, you can always refinance your house later. If the interest rates go down, like everyone is saying, well, you can refinance in 1, 2, 3 years, but you got the purchase price of 2023. That when the interest rates go down, that purchase price is definitely going to be higher, because there's going to be more demand.
Yeah, I'm hearing that from, really everybody. The market's kind of frozen right now, but, you give a couple of points back and people are going to be buying houses again. One more quick question, Santi, since we're on kind of the topic of, kind of qualifying to get a mortgage and debt to income ratio, all that stuff. As a real estate investor, I get my credit checked a lot. And so, because I'm doing refinancing of portfolios and things like that, one of the things that impacts my credit score the most, obviously if I load up credit cards, that will impact my score because I'm utilizing a lot of debt. But another one is, people are looking at my credit all the time. So I have hard credit pulls, a lot of them. Is there any way to get those off of your credit report so that can stop impacting your credit negatively?
Yeah, I mean, they will be removed after 2 years that they check your credit. But here's something that I do personally, because you know that I invest. So what I do is, I have a credit report with the credit scores. And when I'm looking to do a loan, I have my credit report, and I'm kind of like sharing that with the lender. So not everyone has to run my credit again and again. Now, if someone runs your credit, doesn't affect you that much. I mean, I have seen like 3, 5 points. It's not drastically, but you can do things in order to remediate this. Like, for example, reducing all your credit cards to less than 30% and never go over that. Putting your payments in auto pay, like car payments, mortgages, credit cards in auto pay. Don't open many new accounts, because every new account is going to reduce your history, and a big portion, 25% of your credit is the history. So yes, it's going to affect you the times that the banks are checking your credit, but you can remediate that with other options.
Santi, I got 10 seconds left. How do people find you? What's your social media or your website? How do people get in touch with you?
Yeah, they can find me like Santiago Mejia or Santi Mejia or your lender amigo. Those are my names in social media. My phone numbers are everything in there. Website, something, everything.
Awesome. Thanks for joining us on the show. We'll have you back soon. We'll be right back, everybody.
Sure.
Taking a trip in the next 12 months? Airlines are under tremendous pressure and they're practically giving away their unsold seats. Like every crisis, this one will end too. But right now is the best time to take advantage of giveaway ticket prices on their unsold seats. We're not allowed to publish these low fares online. The only way to get these rock bottom giveaway prices is to call. So phone low cost airlines now for airline ticket prices you may never see again.
These are the top 3 questions I get from people about investing in real estate. How much money do I need to get to the next level? How do I find good properties to invest in? Can I even make money in this business when interest rates are so high? I answer these questions and many more in my online course, SFR University, where I show you the strategy that I used to build a multi-million-dollar real estate business in 4 years from scratch. Whether you're just starting out or someone who's looking to scale, this course will have something for you. Join us at sfruniversity.com. See you in the course. Welcome back, everybody. I've got Will Snead back on the program today. I'm a broken record around insurance. It's super expensive, and if you own and operate real estate, then you've got to find a way to lower your premiums. It's just incredibly expensive, Will. Will owns an insurance brokerage called Snead Insurance, and he handles a ton of insurance for real estate investors. Will, it's surprising to me how many of my peers that own large portfolios of rental properties have all of their properties on single insurance policies. They'll own 100, single family homes. They've got 100 right. Single family rent insurance policies, and they don't group them together. I mean, why do people do that?
That's a great question. My guess is that they probably get in touch with a broker early on in their portfolio building career, and then they just stick with them for the long haul and never really look elsewhere, and just don't know. I just think it's a lack of awareness that there are more efficient options out there.
We would literally spend every other day working on renewing one of our policies if we did it that way. Right. Every single one of our houses is on one single policy. Yeah. I mean, I guess why would what is the ability that you have to help people do that differently?
Yeah. Well, I would say about 80% of the time when someone comes to me with 50 different policies for 50 different properties, and I'm able to consolidate that onto one policy, they're going to save money at 80% of the time. 100% of the time, they're going to save time. Like you just said, yeah. I mean, it's crazy to think about. I can't imagine going through 50 different renewals a year, or in your case, 100 different renewals a year. Just the amount of paperwork, the bills. Let's say they want to drop that property because of a claim that happened. That's just exhausting, right? And so ultimately, I do everything I can to try to get it on one policy.
So, you mentioned like 80% of the time you're going to save cost. Why is that? Right. Why do you save cost if you group them together like that? Does it give you some sort of buying power or something?
Yeah, buying power. If you give that carrier $50,000 versus $1,500, there's going to be some breaks there, and they're built. Those policies are built to be more competitive, and so that's why.
What's the downside? There's a lot of upsides. Obviously, it's efficiency with us and it's time, and I do think I agree with you. I think we do save money by doing it that way. But is there a downside at all doing it that way?
I haven't seen it yet. I haven't seen a downside. I haven't seen a scenario where they were penalized for all being on one policy. I will say there was a time where there was a particular client that had a lot of claims. and there was a couple of problem childs on the policy, a couple of different locations. And so what I did is instead of letting the carrier cancel the entire policy, I just said, hey, let's exclude these two. And then I went and found a solution with a different carrier. There's other properties that we left, the more insurable properties on the portfolio, and it went well. So I haven't really seen a scenario where there's a disadvantage of doing it this way.
That's actually kind of smart. So you you peeled off two of the worst properties in the world and found a new home for those, which is probably pretty easy to do.
It's a win-win for everybody. It's a win for the client that they were, instead of having to reshop all 50 of their properties, we were able to remove a couple, leave, let's say 48 with the carrier that was already on it, and both parties were happy. So it's all about just getting creative and trying to figure out what the goals are of the insurance company and also the client, and usually we can find a compromise.
I was talking to a friend of mine the other day who owns a portfolio of insurance or a portfolio of rental properties, and he thought it was amazing that the insurance policy limit was basically twice as valuable as the house was worth. He was like, they give me $200,000 worth of insurance, but I could only sell this house for $100,000. I mean, don't you want to buy less insurance ultimately? I don't want to buy $200,000 worth of insurance for a house if it's only worth $100,000, right?
Well, I'll tell you this. There's a big difference between market value and replacement cost, and investors, typical insurance buyers, have the hardest time really understanding this. So let's say you go and you buy a 6,000 square foot building for $200,000. Well, my job as a risk advisor is to make sure that you can replace that 6,000 square foot structure if there were to be a total loss. So great for you. You got a bang up deal. You bought a 6,000 square foot building for $200,000, but that $200,000 is not going to replace that structure if there's a total loss. And so that's why it's so important to just to have that property insured to the full replacement cost versus versus insuring at what you paid for it, because those are really two separate things. Now, if the client wants to get creative and they really don't value coverage and they're just trying to appease the lender, I'll get creative with them. But right out of the gate, I'm always going to try to insure the property at full replacement cost, because at the end of the day, when a claim happens, that's what they're going to expect from me, and I want to be able to show up with that check.
Well, how much of a difference does a deductible make in a premium that somebody pays for properties? If somebody pays $10,000 a year and they've got $2,500 deductible, how much do you save really if you raise that to $5,000? Is it worth the savings?
I believe it is, and this is the reason why. Is because I wouldn't be filing claims under $5,000 anyway, so you might as well get the deductible up and just take advantage of those premium breaks that you're going to get. I don't know the exact equation or the algorithm that they use. Every carrier is different on how much of a price break they're going to give you for raising that deductible. But if you can stomach it, you can come out of pocket for the smaller claims, get that deductible up to $5,000, $10,000 if you can. That's my recommendation, especially in this market where people are getting penalized so hard for filing claims.
Are you seeing that? Is that happening more often than not, filing claims and getting canceled or something like that, or having your premium go up?
Yes, just a lot. People want to get out of property. Last year alone, I mean, I forgot the number, but I think it was like $190 billion in property loss. People don't want to insure property right now. The weather patterns are tough to determine with everything that's going on with climate change, et cetera. And so property is something that everyone's scared of right now. And it's not the class of business that these insurance companies want to write. And so you don't want to give them a reason to drop you, is my point.
Yeah. As a real estate investor, I deal with insurance not as much as I used to, right? Because I have all of my properties on one policy. But a lot of the people that watch this show, they own portfolios also. And they've got several different business units. A lot of their properties are owned by different entities. They have different banks. They're adding and deleting properties all the time. How do you keep all of that straight, all of that activity, with insurance?
Yeah, well, right out of the gate, if it's a client that has a really big portfolio and they want to manage that themselves, I try to place them with a carrier that gives the client a portal where they can actually adjust those details on their end. In a lot of cases, they're going to say to me, hey, no, that's your job. Well, the good thing about that is we have a great service team here that's willing to manage that for them. It just depends on how they want to go about it. But the key is just to having the right service team in place to be able to, adjust to all those different requests that the insurer is going to have. But obviously, but also giving them the ability to make those changes themselves can be advantageous.
So a portal, I guess, they can log in and make changes themselves and things like that. So it's really not that hard because people, if you've got a big broker or I guess a carrier that you watch on TV and your insurance policy is with that person, you're still, logging in and doing stuff, right? So So what are you seeing just on the ground right now? Changes in insurance. I mean, what is kind of word on the street? Is it going to continue to go up like everything else that we pay for?
Yeah. I would say if you own property, you can expect the increase. It's going up. 20 to 40% across the board. That's the common renewal increase that we're seeing. So just be prepared for that. Be prepared to have a conversation with your broker and make sure that they're remarketing it, and be patient with them, because I can tell you every property policy that they have is probably increasing, and so their service team is working really hard to help place you with a different carrier or just to make sure that you still have the best rate. So I don't see that changing anytime soon, as long as weather continues to look the way that it has over the last couple of years.
Well, I got 2 minutes left. You and I are working on an insurance program for single-family rental investors.
Yes.
I came to you and said, "Here's the problems. Let's find a solution." Tell our audience about that in the last 90 seconds we have.
Yeah, no, man, it's very exciting, and Andrew really helped me understand a huge opportunity in the insurance market right now, or in the real estate space. Isn't insurance one of the biggest items on your P&L now?
100%. It's one of the top 3 things I pay for.
Yeah, exactly. So what we're trying to do is, one, just audit the entire insurance program for these folks that have 10 plus properties, 50 plus properties, or whatever, and make sure that, one, it's structured efficiently, and make sure that they're getting the best rate possible. At the end of the day, my goal and Andrew's goal as we work together on this is to get all of your properties in one policy with one renewal, with one bill, et cetera. Save everybody time, and hopefully get you some savings along the way.
If you guys own real estate like I do, and it doesn't matter if it's commercial buildings or single-family rentals, we are building a solution for you. The website is sfruniversity.com/insurance. SFR University is my consulting practice /insurance, and we'll give you some more info. Will, really appreciate you joining me on the show. Insurance makes a lot of people's eyes glass over, so we try to juice it up a little bit for people. So I appreciate you coming on the show, and we'll do this again.
Thanks, Andrew.
Thanks. We're going to head to a break. We'll see you guys in a few minutes. These are the top 3 questions I get from people about investing in real estate. How much money do I need to get to the next level? How do I find good properties to invest in? Can I even make money in this business when interest rates are so high? I answer these questions and many more in my online course, SFR University, where I show you the strategy that I used to build a multi-million-dollar real estate business in 4 years from scratch. Whether you're just starting out or someone who's looking to scale, this course will have something for you. Join us at sfruniversity.com. See you in the course.
Hey, Lily says AT&T's giving everyone their best deals.
Minus the air quotes.
Best deals.
No need to wink. Others say they give everyone a deal, but not everyone gets the best deal.
Told you, the best deals are for everyone here, with a choice of plans.
You were right.
Is she always right?
Always.
At AT&T, we give everyone our best deals on every smartphone.
Taking a trip in the next 12 months? Airlines are under tremendous pressure, and they're practically giving away their unsold seats. Like every crisis, this one will end too. But right now is the best time to take advantage of giveaway ticket prices on their unsold seats. We're not allowed to publish these low fares online. The only way to get these rock bottom giveaway prices is to call. So phone Low Cost Airlines now for airline ticket prices you may never see again.
Hi, my name is Michelle Merhar. You may remember me from the morning news. I'd like to tell you how getting data and documents into action fast gives you a competitive edge. Digital-first thinking to manage document workflows efficiently are giving all organizations a competitive edge. In fact, digital document automation is an essential process, helping us to become more profitable and to compete. By making any process paperless with secure automation, decisions can be made efficiently, virtually from anywhere. You'll be able to find and share documents securely in seconds. Your staff will be empowered by making optimal use of every office hour. And by the way, the size of your organization doesn't matter. Precision Products has been helping organizations for more than 30 years with paper to digital processes, including scanning systems for any document to premises and cloud document management systems. We make it easy and scalable for your business process needs from the office or other locations, even mobile devices. Contact us to see how we can help your organization succeed. Contact Will Waterall direct at 713-446-5939 and visit us on the web at precisionproductsinc.com.
Welcome back to the show, everybody. I'm going to talk about property management in this segment. I'm going to introduce you guys to Brad Puckett. Brad leads business development for Foundation Property Management, a regional firm in the Southeast. Brad basically consults with real estate investors to let Foundation property manage their properties. Brad, welcome to the show.
Man, thanks for having me. Glad to be here.
Man, Brad, I've got to be honest with you. I have a bad attitude around property management. I think most firms are pretty bad about it. Or bad at it. Obviously, I think you guys are different. You're a rare exception in that world. So compare and contrast for us a little bit. What does Foundation do that everybody else seems to not do in property management?
So I wouldn't say people don't do it, but I would say the three kickers, communication, accounting, and maintenance. Those are the three pillars that put a bad taste of property management into someone's mouth. So when you really dial in and focus on those three, it's inevitable to be successful.
I mean, that's a good point. A lot of times we property manage our own portfolio as a real estate investor. And I get questions all the time because we don't property manage anything for anybody else. People ask me, who do you use? Who do you choose? What are some good questions, Brad, to ask? If somebody's going to interview a property management company, what do they need to ask that, company, somebody like you, to interview you before they hire you?
Couple big important questions. One, what's your screening process, right? Because here in our market, eviction's not an uncommon thing, unfortunately, if you don't find the right tenant. So one, what's your screening process on tenants? One, how often do you inspect the properties? How often are you there? And two, how do you handle maintenance? Or three, how do you handle maintenance calls, right? Do you have an in-house maintenance team? Do you outsource absolutely everything to vendors? Do you have 500 properties and 2 employees? Well, then you're outsourcing everything. How reliable are those vendors?
Brad, is it a fair question from a leasing standpoint? How many days, do you have an average, how many days that somebody could expect to, get somebody into their house?
So I can't speak for other property management companies, of course, but our goal personally is 21 days or less. Now that's okay. 21 days from us taking possession of the property. There's always something that needs to be done when we take over, whether it's just a deep clean and a silly Glade plug-in that makes it smell awesome, or if we have to go in and patch sheetrock, paint walls, whatever the case may be, our goal is 21 days or less. But that is also seasonal. Right now we are seeing a little slowdown in that. But I think that's also across the country.
Yeah, well, I agree with you. There's definitely a slowdown. There's fewer prospects out there shopping for homes, both on the the acquisition standpoint, if you're buying a home to live in, owner occupant, or renters. A lot of renters are slowing down on the moving process, and a lot of that is seasonal. But Brad, when somebody wants to move their portfolio of rental properties to Foundation, is there an inspection process that you go through? Like before you take it on, you do an analysis of the property to give them an idea of, what's the target rent and here's how we get there. Like talk us through that process.
Yeah, so one, we definitely run an analysis on the property, right? Because one, we got to see, is it tenanted, is it vacant, what's the rent, what's the condition? But no matter what, any property that we bring over from another property management company or somebody who's self-managing, we have to at least drive by the property first. Don't necessarily have to get in, but for anybody ever looking into the Memphis market, we're a very street by street market, right? And I tell investors this all the time. The reason I drive by isn't to find something wrong with the property, but the little joke I tell them is, man, look, I want to set everybody up for success. So if I drive by the property, we take it on, or if I don't drive by and we take it on, and then 6 months down the road, there's a drippy faucet, right? And I go to our maintenance guy and I say, hey, can you go fix this drippy faucet? And he goes, man, I can't. Well, why not? Well, I didn't bring my gun to work, right? That's not a neighborhood or a street that fits into our portfolio. So knowing the neighborhood, knowing the street, seeing the condition just of everything around is definitely something that we do before ever bringing on a property.
You guys are taking properties on from people all over the country. Do you find that communication, you mentioned communication earlier, how often are people pinging you about, or is it like daily? Are you having to field calls once a day or emails about somebody asking if their property's occupied, or do you kind of set them up on communication protocol, that kind of stuff?
So it's all upfront. Here's what to expect. If you set the precedence of, hey, we don't know what's going on, then yeah, you're going to get those daily calls. However, for us here, our leasing team meets every Tuesday on all of our vacant properties going under renovation, any rent ready work. And then our leasing team knows to update their specific owners every Tuesday until it's tenanted. So we do a weekly update for vacant properties, but that's just our process. Yeah.
I heard a crazy story from a friend recently that utilizes a different property management company than you guys, but they were quoted $10,000 for a new roof. This was during a turnover. Tenant moved out. And, the property management came in and said, you need to do all these things to turn over this property, one of which was that new roof. It was old. The $10,000 was about $5,000 more than it actually should have been. I know because I bought 50 roofs last year. They were about to hire my team actually to install that roof. And the property management company was like, nope, you're contractually prohibited from hiring anyone but our people. Is that real life? Do you see that from other property management companies?
From certain ones throughout the region, yes. For us, that's not the case. And no, Andrew, that might not have been 100% true. $10,000 might have been the bid. It was the retail bid. They went through somebody and found a really big name and said, hey, will you go put this roof on? But as you know, you put on a bunch, you don't pay retail for things. True. And if you pass that savings along to your investors, everybody wins.
Do you guys? So you're speaking something that is not something that I'm familiar with because I'm not in the property management world. So do property management companies routinely mark up things like that?
So every property management company marks up with either a supervisory fee or a maintenance fee or anything like that. The key is finding one that doesn't do it on a flat scale, because you see companies throughout the city that'll say, okay, every repair is 10%. Right, 10%. We go out and fix a faucet, 10%. We replace a toilet, 10%. But where it really gets you is where now you replace a water heater, you replace a fence, you replace a roof. That 10% adds up. Yeah.
So you guys are on a flat fee then. So you're not a sliding scale or what?
We are on a sliding scale. So
you're sliding scale. Okay.
Yeah. Anything over when you hit the next scale, it drops down in percentages.
That makes sense. So leasing is the most important thing. If a property goes vacant and I can't get it turned over and it's sitting vacant, I'm losing revenue. I'm never going to get that revenue back. So you mentioned 21 days. How do you guys lease up properties that fast? What's the process?
So
without
the key
giving
is
away
to get it
trade
marketed
secrets.
yeah. The key in a perfect world is to get it marketed as soon as possible, right? Listed on all the major sites. People know Zillow, Trulia, Apartments, the whole 9 yards. His lease is coming soon. Getting the crews in there and getting work done and having a superintendent that oversees that project is key to make sure people are supervised, so you know that, hey, they're getting it done and they're getting it done in a timely fashion. That mixed with having some really good crews is super important. That way, the day that it is safe, it's clean, it's functional, hey, let's make it available for viewing. We personally do self-viewings. There's no way with the amount of properties we have that we would be able to send a leasing agent out to each property. So we do self-viewings, and that's made a world of difference.
Yep. You're putting it up on the internet as coming soon? Because there's a couple schools of thought. Some people don't do that, but it sounds like you guys do that.
Yeah, we do that.
How far in advance do you put that up?
As far as we possibly can, honestly.
Oh, really?
I know this is a rare situation, but last month we leased a nice property, a neighborhood, 3-bed, 3.5 bath, without it being viewed. The lady went online, she saw really good pictures, she brought up funds, brought the security deposit, secured the home, and then the day that we finished everything, she went, saw it, came, picked up keys, and moved in. It was practically a one-day thing.
Sounds like, but that's not the rule. That's the exception. The sign the lease before you see it. It seems like in the single family world, people actually want to go and walk through the house and look at it before they sign a lease. When I was renting in Houston a few years ago, they were signing leases sight unseen. I like what these pictures look like. I'm signing leases, but I find at least that in the single family world, people don't do that. They want to walk through and touch and feel and see kind of what that house is about.
That one was a very exceptional one-off.
Yeah. Security. How do you guys manage security on properties? There's a lot of, I got 1 minute left, so this is going to have to be quick, but there's a lot of theft that's happening in urban environments all over the country. A lot of rental property owners are victims of that. How do you guys look at security?
1, cage and AC. Make sure it's caged. 2, we put up cameras and tell people we put up cameras. We put signs in windows that say, smile, you're on camera.
Yep.
There's no secret. We don't hide them. We make it known.
Yep. Brad, I got lots more questions about property management. We'll do this again. Thank you for coming on the show. Have a great rest of your day. We're going to head to a break, everybody, and we'll be back soon.
Thanks for having me.
Hey, Lily says AT&T's giving everyone their best deals.
Minus the air quotes.
Best deals.
No need to wink. Others say they give everyone a deal, but not everyone gets the best deal.
Told you, the best deals are for everyone here, with a choice of plans.
You were right.
Is she always right?
Always.
At AT&T, we give everyone our best deals on every smartphone.
Taking a trip in the next 12 months? Airlines are under tremendous pressure and they're practically giving away their unsold seats. Like every crisis, this one will end too. But right now is the best time to take advantage of giveaway ticket prices on their unsold seats. We're not allowed to publish these low fares online. The only way to get these rock bottom giveaway prices is to call. So phone low-cost airlines now for airline ticket prices you may never see again.
Thanks again, everybody, for tuning into the show. We interviewed a lot of folks today, and the emphasis really was on real estate investing. I'm a real estate investor, so naturally, the questions that I have for my guests that come on the show and a lot of the people that we invite onto the show are going to have a perspective in real estate investing. So this business has gotten very difficult because the costs have gone up. Interest rates are up, the cost to operate your business is up, insurance premiums are up, taxes are up, everything is more expensive. Real estate prices are more expensive. There's nothing that's going down. So it is imperative right now to work on the education piece of real estate investing. The education